The next step is to work our way through the tax analysis section. So let's go ahead and work through that right now. And then I'll have some more comments for you at the end of this. The tax analysis section is down below. In fact, it's right here. To start off, what I did was I merely carried down the net operating income from above. This line here, it actually came from right up here, the net operating income. Just carried that down. To calculate the taxable income, there's really two deductions that we're taking. One is for interest and one is for the depreciation. Okay, and that's done right here in this section. So where did the interest come from? Well, we've done that in the last section, in section 5. Here is the interest calculations here. All I did was carried that down to here, and it appears. Next section, depreciation. Where did the depreciation come from? Those calculations are done below, and then they're carried back up here, but let's go look at the depreciation calculations. That's right here. To calculate the basis of the property, first, the purchase price was $1,004,000. That will be the basis. However, we're allowed to add to that the transaction costs at the time of the acquisition. That was $21,000. We add those two numbers together, and then in terms of calculating the depreciation, remember, we can only depreciate the improvements on the property. So how do we allocate between land and improvements? Well, we take the total of those two numbers, and 20% of that is the value of the land. That's $284,200. And the balance of that is the value of the improvements, $1,136,800. And now, to calculate the depreciation, you're allowed to depreciate it over 27 and a half years. Take that total, divide it by 27 and a half. We come to a yearly depreciation of $41,338, and all I did was divide that by 12, and that is $3,445. Now, let's go back up. That number was added here, brought up here, those depreciation numbers. Now, to calculate your taxable income, we take the net operating income, subtract out the interest, subtract out the depreciation, and we get our taxable income. In this case, it was a negative $19,306. We have a negative taxable income. Now, in the past, we used to be able to take this negative taxable income and deduct it against our ordinary income. There's a limitation on that nowadays. You can deduct up to $25,000 of the tax loss against your ordinary income. And if we do that, we can take the tax loss, offset it against our ordinary income. By doing that, if we're in a 30% tax bracket, we will save $5,792 in taxes. Okay, that was done across the board right here. In this section, the analysis section, the next thing was, well, calculate what the taxes are on the sale of the asset. We said there's a 5-year holding period. Well, what will the capital gain taxes be in that year at the end of year 5? Well, those calculations are done down below here. Here's the gain on sale calculations. Again, let's work our way through this. It may look difficult, but it's not. The original purchase price, $1,004,000, and the transaction cost, $21,000. That gave us an initial basis of the property of $1,421,000. If we had done any capital improvements during the term of this investment, we would have added them in here, but we don't. To calculate the adjusted cost basis at the time of the sale, well, you have to deduct out all that depreciation that you already took during the 5 years. This $203,000, where did that come from? That is this number here, the depreciation, this line here. If you total that together, that's the 203,000, and that was just carried down to right here. Next, so the adjusted basis then is 1,217,754. So that's your initial basis. If we sell it for more than that, we have to pay a tax on it. Selling price, 1,645,000. Where did that come from? To calculate it, we look at the net operating income in year 6. That's why we did that year 6 calculation. And we're going to divide that number by the cap rate, by a cap rate. What cap rate do we use? Well, we've talked about that briefly. I said that the cap rate that we're going to use at the end is the same as we did at the beginning. When we bought the property, we bought it at a 4.78% cap rate. So hopefully, to avoid introducing a bias into the model, we use the same cap rate. Now, that number is up for discussion. We'll talk about that later on. But that's how we came up with the selling price. The selling price here, 1,645,106. Take the net operating income in year 6, divided by that cap rate, and we come to that 1,006,000. Okay, less the expenses. We came to 57,579 in selling expenses. We're allowed to deduct that. And then the adjusted selling price, 1,587,528. That is the selling price. The difference between these two, the adjusted selling price, the 1,500,000, and the less the adjusted cost basis, 1,217,000, that's the gain. So the gain is $369,774. Now, to calculate the taxes, we have to remember this. What the tax code says is that at the end of an investment, to the extent that we took depreciation, and we did, 203,000, that's this number here, we owe a tax on that. That's not gain, it's unrecaptured depreciation. So we have to recapture it and pay a tax on it. That is a flat rate of 25%. That's just built into the tax code. So 25% of, we owe taxes on 25% on 203,246. Now, the balance of the gain, 166,528, that is a long-term gain. So we took the total gain, 369, recaptured the depreciation of 203, and subtracted those two. We have a long-term capital gain of 166,528. Now here's just the tax calculations. As I said, first of all, unrecaptured depreciation. We owe 25% of the 203,000. That's 50,000. And we owe 15% of the 166. That is 24,979. Add those two together, our total taxes are 75,791. That number was then just carried up to here. And here it is. Given that, all I did was, again, start with the cash flow before taxes number, which was calculated like this. You took the cash flow before taxes, 13,393, and I carried those down, this number here, carried it down here, all the way across, and then I subtract out the total taxes. Total taxes, if we had done that here, the benefit to the owner from in year 1 of the investment was 5,792. We saved that in taxes, remember. Carry that down here. Add that to the cash flow before taxes. After tax, 19,185. Did the same calculations across. Now, over here, we actually owe taxes, and we calculated what the cash was that we get out of the sale, subtract out the taxes. We had the cash flow from the sale of the asset, then subtract out the tax obligation, $73,000. Our cash flow after taxes, $902,199. That's what this number is across the board here. I know that is a lot to absorb, but most of this is done automatically for you. And later on in the course, I'll talk about where you have to make an adjustment, especially in this situation where you have a negative cash flow. Enough of that. What we do next in here, I'm going to give you a more in-depth discussion of the tax laws. A lot of you are not interested in that, so I guess you can just go ahead and skip those couple of lectures, but I want you to know it's there, and that if you want to know more about this in more detail, again, it's there for you. All right? Thank you, and let's just move on to the next discussion. Thank you.